Welcome. Today, we're joined by Rob Whitby-Smith, partner at Albion VC. We're going to discuss Albion's portfolio and their approach to investing. Welcome, Rob. Looking back at Albion, a very long established VCT. Tell me a little bit about that history, where it's come from, where you're at now, and what you're looking to do.
Thank you. So we originally started as part of Close Brothers in the mid-90s when VCT legislation was first introduced. And in 2009, the directors of Close Ventures, which was a subsidiary of Close Brothers, had the chance to buy our business from Close, and we formed Albion. So it's been Albion since 2009. And when we bought ourselves out, we were a fairly small VCT business. And over time have expanded from sort of 150 million under management to now nearly 650 million in VCTs. And we manage a number of other funds, including the UCL Technology Fund. So today we are a team of roughly 50 people, and investing. Our focus has increasingly become B2B software and healthcare at Series A.
When we talk about that focus of B2B software, Series A, why is it that you're focusing there?
So we're quite thematic investors. So even within B2B software, we have a number of categories that we focus on. So for example, digital health, cybersecurity, fintech, data and AI, deep tech, and clean tech. And what we're trying to choose are sectors where there is, as part of the second machine age, there's a digital transformation going on. There's huge structural change and growth, with companies being able to, and incredible innovation coming out of UK universities to solve the big problems, facing the world. And that's where we see enormous value will be created, regardless of where we are in the economy and the cycle. And software businesses, which is where we focus, have the added benefit of recurring revenues, high gross margins, very capital efficient, so incredible business models and economics that mean that taking part in that incredible change can be done whilst creating a lot of value.
And so at the Series A stage in particular, one of your focuses, there are lots of VCs. What do you think differentiates Albion as an investor? And I guess you could say in some ways, like, why did the Albion portfolio pick Albion?
When any founder picks a VC, there's always going to be an element of cultural fit, chemistry. Do we get on with them? Could we see, it's like entering a long-term relationship on average 7 years. Could we, through tough times and difficult decisions, we'll better, work with them. So I suppose that's always the starting point. But then, why do they specifically choose us? It's mainly around, I guess, our sector expertise and our domain knowledge. So we've been investing in B2B software and healthcare for nearly 20 years. We've got about 50 portfolio companies currently, but we've invested in a lot more than that over time. So we've got lots of exits. Had exits to all the big brands: Microsoft, Oracle, Facebook, Apple, Siemens, Hitachi. I'll stop there. So we're an experienced investor in those, and we have a lot of experience getting companies from seed and A stage to Series B, when typically we'll step back at a new investor, we'll lead the round and take the company forward to the next stage. So I guess companies choose us for that. We've learned that over time that having our own in-house capabilities to support companies is helpful as well. So we've got a head of talent who previously performed that role at bigger funds like Balderton and EQT. And what she does is help companies get the culture right with the hiring process, organizational design, because we know that most of the spend in software companies is on people. And actually success or failure will be hiring the right people first time and them being motivated towards the big goal. And so we've invested time. We invested in time and resource on go-to-market and having expertise in our network to help companies there. And so I think those, when we speak to founders afterwards, obviously after we've invested, they're very nice about why they chose us. But often it's to do with that chemistry fit, the sector expertise, and how we're able to help companies.
So looking at the portfolio now, if I'm an investor coming in, how many companies am I getting access to straight away? And how many deals do you typically do new each year?
In the VCTs, we've got about 50 B2B software companies at present. We typically make 5 to 6 new deals a year. As the market has changed, we've recently, as you know, increased our investment rate, and we're expecting to make 6 new investments this month, and probably 14, 15 this calendar year. So you can see the portfolio is refreshed. We're always seeing new opportunities, but it's well diversified across those 50 companies. There are 3 companies that have scaled much further than others, so have quite high percentages or relative to the NAV. So Contexa, Egress, and Pravica, probably companies that be useful to find out a bit about if you're looking at the portfolio. But I'll talk about those later.
Yeah, and I mean, that is very common in venture funds. As things pull away, they tend to dominate a little bit.
You'd have some success.
Exactly, dominate more than that. Yeah. Deal flow and sourcing deals is the lifeblood of what VCs do. How many deals a year do you see? And how do you guys find the deals? Particularly, as you said, you've ramped from that 4-6 up to 15.
Yeah. So we have scaled our team as well over time. So we've recently hired I think 8 investment execs over the last 3 to 4 years. So we've got quite a large investing team now. But our main source of deals are referrals, either from the founders or earlier stage investors like angels and seed funds, and other Series A investors looking to syndicate with like-minded VCs. In terms of how many deals or how many potential investments we see per annum, it's a lot. But a lot of it is, cold emails, and there's a, pretty poor signal to noise ratio there.
Yeah.
So it's mainly from referrals, people who know what we look for, know what, I guess the seed funds and the early stage investors have acted like a filter for us. They pre-selected what they think are the best opportunities, and then we select again from that set.
Yeah, and it's a good way of working, isn't it? You can end up having that partnership relationship with them in the ecosystem. And when you're building conviction in companies, what does that look like? And what is the typical Albion company? What characteristics do they share?
So every company is different, and it's hard to generalize. I guess they're all, we're seeking category leaders, and we're seeking companies that can build big businesses. So let's say 100 million recurring revenue at scale. So to do that, there's got to be a big market. There's got to be a company's got to have and be able to build a defensible moat over time. And the team have got to be, they won't be fully formed at the point we invest at seed or Series A, but we've got to believe they've got the ability to hire and build an amazing team that can achieve that. Those, I guess, would be the key factors. But in terms of, because you could say there are similarities between the portfolio. The cybersecurity companies are often trying to scale in a similar way. Digital health businesses are often, trying to scale in a similar way. So they do interact with each other. There are active conversations on WhatsApp between the portfolio CEO, CTO, CFO groups. Being part of a community it definitely helps.
So the fund, as you say, has been around for quite some time, one of the earliest VCTs in the market. How has it performed in recent years? And are there any particular current investments that you're excited about right now?
Yep. We don't have favourite children. I'll start with that piece. They're all amazing investments. I think the long-term performance has been very good, but it's been good also over the last 10, 5, even 1 year. So I think our return over 5 years is something like 50%. And over 1 year, it's held up despite a dramatic change in the public markets. I think the key reason for that, and we often get asked, why is that? How come public markets have over-halved in the tech sector and your fund hasn't? A key reason is that our portfolio companies are growing very well. So we've got, across those 50 portfolio companies, it's something like 285 million annual recurring revenue. And that grew 50% year on year to September this year. So 50% growth, 50% reduction in multiple, you stay roughly flat if you're looking at things from a recurring revenue perspective. We also have, like all VCs, downside liquidation preferences, so that if we get at exit, we get the higher of cost or our share in the business. So there is some protection, some natural structural protection, which is helpful. But the main thing is, for small companies, for early stage companies, what's their growth rate? Are they scaling? So we're delighted that our portfolio is doing really well.
Great, no, it's great. And looking at the portfolio, and obviously exits are what drive returns. Have you had any recent exits you can talk about? You've obviously had exits over time.
Yep. So we have, it depends. So in 2018-19, we had a couple of 10Xs. We sold businesses to Oracle and Siemens. In the last year, we've had 5 exits, and most in the 3 to 5x range. So the biggest one was Apple buying Credit Kudos, which was unfortunately Apple made an offer that no one could refuse. Obviously a lot, of course, yeah. Whereas obviously we would have loved to, although Apple shares wouldn't have been too painful either. The company had much more potential, but when a corporate offers a price, tomorrow's price today, it's very hard to. And the other exits were to, Myomezami, Frazee, were to private equity-backed companies.
So if we're looking at venture at a wider level, there are obviously a large number of failures. We accept that. That's part of the game, as well as obviously the successes. Yep. Have you had any significant failures recently, and what have you learned from them?
So absolutely, it's a game of outliers. And if anyone didn't have any losses, something would be very wrong, because in early stage investing, you have to take risks to get the return. I think our returns are very public, because obviously the VCTs publish their information, so you can compare book value to cost, and you can see very quickly where we've made significant write-downs. I think of our roughly 50, we've got 5 that are valued below 50% of cost. I think maybe 3 or 4 are almost, if not entirely written off. And over time, we've had more. We are a learning culture, and we're humble enough to realize we don't know it all, despite the fact that we've all been investing together for a very long time and seen lots of things. And so we try and learn from both the losses and the successes. I don't think there are particular themes. You could generalize and say businesses fail because they run out of money, but or they don't grow enough, or they fail to fundraise. But I think in most cases it's a number of factors that led to something not working out. Yeah. And sometimes you think the reasons, but they're not the reasons.
So if we look, we're sitting here at the tail end of 2022. Yep. It's definitely been an interesting year, as you hinted at with that, the sort of where the public markets have gone. And that has had some impact on later stage venture capital valuations. Obviously, they're a bit more comparable. You talked about your portfolio and how it stayed resilient. How do you see that continuing or changing over the next sort of 6 to 12 months for new investors coming in? Obviously, interest rates are going up around the world, for example.
The later stage investors, so the further you get C, D, E stage, and those that are maybe a year trying to invest just pre-IPO, they are most affected by what's going on in the public market valuations and what corporates are willing to pay. Because they're only a few years away, and if the markets stay at current price, those will be their returns. When we're investing in new investments, if our average holding period is, say, 7 years, it's a long time before. So the markets, may go through very tough times for 2-3 years. But so long as companies, are resilient, survive, and manage through sensibly, then actually you've got some of the best companies in the world being created in recessions because they're created so capital efficiently. Microsoft would be a great example of that. In terms of, how do we see the next few years? We believe, or what we've been trying to do is build a portfolio of B2B mission critical software companies in sectors where, like digital health or cybersecurity, healthcare providers can't really turn off digital health provision. If they were to replace it, it would be more expensive, and everyone's seen how effective it is and are born into it. Companies, even if they were to, let's say they're an airline and they downed all their planes, they can't turn off their cybersecurity protection. So we're investing in spaces where we hope there will be. We would expect growth rates to be impacted. It would be naive to think that if there's a huge world economy disruption, that it won't affect growth rates. But I guess we're taking a long-term view. We've got evergreen funds, and our investment horizon is such that no matter what the world economy throws at the portfolio, hopefully they can get through it, become stronger, and then burst through the other side.
So some of the investors that invest with Further are new to VC. They're experienced investors, but venture capital is a new asset class for them. How do you think about VC alongside other potential investments like the stock market, art, or crypto? Where does VC sit?
My personal view is that the VCTs offer the opportunity to democratize returns in early stage tech investing. And the world is going through, transformational change at the moment, and there are huge returns to be made there. So I think my personal view would be it should be a part of anyone's portfolio. I'm not saying it should be all your portfolio, or even a significant, a majority proportion of it, because it is high risk. But I think it'd be a shame not to access those returns given the opportunity.
The other alternative for people who are interested in VC, particularly early stage VC, is that they could potentially use crowdfunding websites or do angel investing themselves. How does professionally managed funds, how do they compare to those options in your view?
They're very different. Investing in a VCT is like investing in an investment trust with a diversified portfolio, a manager, with in our case, nearly 20 investment execs trying to, find, source, select, choose, monitor, build, help them build their culture, all sorts of things. So that's a very different proposition, I think, to what you could do is certainly through crowdfunding. I mean, as an angel investor, typically, I guess it's an individual investment. Maybe you know the team very well. So I think they're complementary. But I think if you're looking to, for a diversified portfolio to access VC returns, then it would be the VCT approach.
To sum up in a quick sort of elevator pitch, why should an investor on Further Today choose a VCT and specifically choose Albion?
So I would recommend people do access the returns available from early stage tech investing. I think it's an incredibly exciting time to be accessing those sectors and companies, and the quality of entrepreneurs is amazing. And then why Albion would be similar to my answer I gave earlier about why founders choose Albion, which is, I guess, our brand, our reputation, our expertise in B2B software investing over 20 years, a big diversified portfolio of companies in that space, hopefully a good partner for the long term.
Fantastic. Thanks, Rob. If you'd like to learn more about Albion, then check out the fund page that you're on right now. And if you've got any questions, then use the live chat or the email function to get in touch with us. Thanks.